Hello, everyone. My name is Trevor Ray Zimmerman, and this is part 4 of a series of presentations on how our economy can move toward a more equitable income distribution. After viewing this presentation, you will be able to describe the two proposed solutions to income distribution, understand the history behind the minimum wage, and identify the long-term economic impacts of the minimum wage and raising taxes. As discussed in a previous part to the series, the government can coerce natural monopolies to operate equitably. One could argue that if this is the case, then the government can certainly coerce firms within other market structures to pay people what they deserve. The first documented implementation of minimum wages occurred in New Zealand in 1894, with Australia following closely behind in 1896. Many other countries followed suit. In its application, minimum wage was meant to apply to certain classes of people, namely women and children, or certain industries, which were paying absurdly low wages for the labor they employed. Prior to World War II, minimum wage was internationally seen to be best used as a temporary measure to correct for the market failure experienced in specific industries and encourage the creation of private collective bargaining between the employer and laborer for a mutually acceptable form of compensation. It was not meant to be applied in industries or to people groups who had already developed sufficient collective bargaining relationships. Although many states had enacted a minimum wage, a federal minimum wage was not established in the United States until 1938 under the Fair Labor Standards Act. The federal minimum wage was narrow in scope and, according to Starr, relegated to, quote, workers engaged in interstate or foreign commerce. In contrast, as of July 24, 2009, the United States federal minimum wage is $7.25 per hour for all covered, non-exempt workers. In a span of 31 years, starting from 1978 and ending in 2009, the minimum wage for all covered and non-exempt workers has been increased 10 times. Proponents for increasing federal minimum wage further state it has not corrected enough for income disparities, not kept pace with inflation, and not reflected the productive gains made by society. Furthermore, increasing the minimum wage would help demographic groups who are discriminated against, bring people out of poverty, reduce the taxpayer burden for government assistance programs, and help the economy grow by allowing people to have more purchasing power. A minimum wage can be seen as a price floor. Price ceilings and price floors are ways the government can correct for market failures. With a price floor, the price for obtaining a unit of labor cannot be below the government's set price. The quantity of labor supplied for employers would increase from its equilibrium quantity. After all, who would not want to work if minimum wage was raised to $20 per hour? There would be a surplus of workers flooding to the firm, ready to offer their labor. On the other side, the quantity of labor demanded by employers will decrease from its prior equilibrium quantity. Some employers simply will not have the budget to justify hiring laborers at the newly set price floor. Well, there's nothing left to be done for the surplus of unemployed labor other than further government intervention in the form of subsidies. More subsidies translate into higher taxes. Increasing minimum wage can also affect the market structure mix in the economy. McConnell points out that increasing the minimum wage, quote, can tilt the local market in favor of highly capitalized chain stores, end quote. Market power is concentrated into the hands of firms that have enough invested into physical capital to compensate for the increased cost of employing laborers at a newly set minimum wage. Another alternative, proposed by Cannon, is merging, to spread the, quote, total cost of complying with government regulations, end quote. The disruption of normal resource market behavior through a permanently set minimum wage and the frequent increasing of it in the last 3 decades has served as fuel on the fire for the creation of increasingly concentrated markets. As market power becomes more concentrated, the conditions of both equity and efficiency are violated. This is literally a matter of life or death. Fulton points out the efficiency loss produced by market concentration in healthcare is, quote, associated with higher hospital prices, end quote, and, quote, higher mortality rates, end quote. In a violation of equity, the New York Times points out that, quote, lack of competition in the job market can cost workers on average 15 to 25% of what they might otherwise make, end quote. Rather than increasing the well-being and compensation for the use of labor, increasing the minimum wage simply takes society further and further from an equitable income distribution. Businesses will continue to get bigger, the government will become increasingly involved, consumer surplus will shrink, the household as owner of productive resources will have little room to negotiate for equitable compensation. All of this will continue to worsen if society persists in not viewing the minimum wage for what it is. It's a price floor that disrupts normal, competitive market behavior. Minimum wage, various other regulations, and policy decisions have created the optimal conditions for market concentration. With increased market concentration comes more power and therefore more wealth. Some see the solution to the United States' income distribution problems in the form of, quote, increasing tax rates on the richest Americans, taxing billionaire wealth, and making corporations pay their fair share. From Oxfam, end quote. This is being played out in current federal budget policy, in which CNBC reports that Biden, quote, proposes tax hikes on the ultra-wealthy and corporations, end quote. The proposed budget seeks to increase the corporate tax rate from its former 21% to 28%, capture more money from high-income earners by raising the top individual tax bracket to 39.6%, and impose a billionaire minimum tax of 20%. Furthermore, it will end tax breaks on the rich oil and gas companies, treat carried interest as regular income, and again, quoting CNBC, quote, end tax deferrals on the gains from like-kind exchanges, end quote. It appears that the wealthy and corporate America will finally have its reckoning and pay its fair share in taxes. Going back to our circular flow model of the economy, the rich corporations are collectively defined as the firm. A firm is simply an entity where production occurs. It uses productive resources as an input, and its output are goods and services. A firm's survival is dependent on balancing both its implicit and explicit costs with the revenue it produces. No matter the market structure, a firm will always maximize its profits by producing and pricing goods and services at the level where the marginal costs are equal to the marginal revenue. Within the price the household pays for goods and services are wrapped up all the costs that go into production. Surprise! For a firm, taxes are considered as part of the cost of doing business. While the initial incidence of tax occurs at the firm, it is, according to Durbin, quote, shifted to either the buyers of the firm's products and or to the productive resources employed by the firm to produce its goods and services, end quote. The significance is that all taxes are ultimately borne by the household. Taxes are passed forward to household as consumer by the price paid for desired goods and services. Taxes that are not passed forward fall on the household as producer. These are the entrepreneurs and owners of the firm. Entrepreneurs and owners of the firm then try to find avenues for getting inputs that cost less. This stems from the motivation of either the survival of the firm or so that prices of goods and services for the household as consumer do not have to be marked up so much. Options available include restructuring the firm to use less labor and more physical capital, lowering compensation for the use of labor, or simply picking up the entire firm and shipping it overseas where labor is cheaper. Raising taxes for corporate America puts a squeeze on the average American citizen. On the one hand, they have to pay more for goods and services than they used to. On the other hand, there are fewer jobs and lower rates of compensation available with which to pay for the newly marked up goods and services. The mistake made is thinking that corporations are individuals with money. The individuals with money are you and I. Money is used as a vehicle to help the firm, as an entity continue its transformative process in which it breathes inputs and exhales outputs. The household reaps the rewards or bears the consequences of the existence of the firm by decisions made by the household. Society's previous and ongoing attempts to bring about an equitable distribution of income have resulted in a new self-perpetuating, self-destructive cycle. When the government increases the federal minimum wage for the household, it causes further market concentration at the firm, reduction in the use of the household's labor, and increased consumption of goods and services by the household as consumer. Inflation inevitably results. The household screams for the government to levy higher taxes on these concentrated firms, which are too rich and charge too much. Rather than punishing the firm, the full weight of taxes comes crashing down on both household as consumer and household as producer. The household as consumer has less income with which to buy goods and services offered at inflated prices from the firm. The household as producer loses the benefit of utilizing its productive resources at the firm, as the firm either uses less labor, closes, or perhaps even moves to a new country altogether. The household needs more money, so it comes back to the government asking for increased federal minimum wage. The cycle continues with increased levels of government involvement. Much like a flushing toilet, the household and firm will continue to swirl down the drain until all that is left is an empty toilet. The government. Thank you for your attention. This concludes part 4 of our presentation. In our next and final presentation, we will explore future remedies to the problem of equitable income distribution.